Good morning, everyone, and thank you for joining us today for DePutter Market Update. I'm Trevor Fleischfresser, Territory Sales Rep out of Swift Current, and I'll be your MC for the day. A little brief introduction for John. As founder of DePutter Publishing, John leads the company's commitment to turning agriculture and commodity news and analysis into successful marketing strategies. John's goal since establishing DePutter Publishing Limited in 1981 has been to help farmers run profitable businesses and reduce market-related stress and confusion. For today's webinar, John will provide a global markets update followed by a crop market update. As well, he will touch on his Good Morning Prairies and his market advisory that we offer to you guys as well. With that, I would like to thank you, John, for taking the time to be here today and share your knowledge with us.
Well, thank you very much, Trevor. It's my pleasure to be here today. And of course, I come to you today at a time when we are living in a very different world, suddenly, than we were living in 2-3 weeks ago. We're witnessing human tragedy of a massive proportion and seismic shifts in the markets in which we're involved. As I move through this, please make note of any questions or comments that you might have. And as Trevor mentioned, you're welcome to use the Q&A button on your screen. We'll have a quick question period after I move through the slides. Meanwhile, Trevor mentioned that he used the words stress and confusion. I've been involved with the markets for over 40 years, and I've never seen anything the likes of which we are into here today. We're keeping you in touch with our morning reports that come out first thing. The Good Morning Prairies reports are brought to you free by Syngenta. So if you're not receiving those reports, please let your Syngenta rep know, or you can contact the DePutter office by using the coordinates below, the phone number and the email address there to my colleague, Wayne McLean. We're also providing for you the DePutter Market Advisory Service. This comes to you courtesy of Syngenta. They're looking after your subscription for you. And while the Good Morning Prairies report just tackles the news and just gives you the overnight reports that we gather together and offer as a news aggregator for you, the DePutter Advisory Service features my thoughts and that of my colleagues on the markets and gives you some guidelines and ideas with regards to strategies, recommendations. We offer opinions, that sort of thing. Again, if you're not getting these reports, let us know. We'll help you out with that. Now, as we move through the markets today, we've come out of a time through COVID, and there still could be more to that. We don't know where the pandemic or the endemic, as some might call it, could lead us. We see a lot of weather variations. Certainly in Western Canada, we're coming off a year of very challenging weather in many areas of the prairies. Some people would relate this to climate change and some not, but regardless, we're moving through some turbulent times with the weather. And now suddenly we have this entirely new dimension, this war situation in Ukraine. And through it all, I try and go back to my basic tendencies and indicators and so forth that I've used over the course of the last 40 plus years. They're not working quite as well as they have at times in the past, but I still want to remind you of them because they still do operate in the background through even these turbulent times. And so first of all, it's a good idea to remind ourselves that cycles will continue swinging from high to low, from good times to tough times. And during the good times, we need to remind ourselves to prepare for tougher times ahead and vice versa. Remember too that one extreme in the market creates an opposite extreme. In other words, dogs become stars and stars become dogs. And the biggest stars can become the worst dogs ultimately. And likewise with the worst dogs becoming stars. And I'm going to give you some examples of that today, because there are always lessons to be learned in the markets, even as we move through times such as this. When we look back over the decades, some of the biggest bull markets in history have ended with very sharp peaks, and I call them blow-off tops. And that's when a market runs higher and higher amid panic buying and short squeezes and that sort of thing. And very often these bull markets will not last long. The peaks will come very quickly, kind of like craggy mountain peaks, and then you move back down into valley lows. And so that has been a historic situation for the grain markets since time immemorial. The way a market responds to news can be more important than the news itself. So I will continue watching markets for signals that they are unable to go higher even amid bullish news, or that they are unable to go lower even when the news seems absolutely, extremely, unquestionably bearish. Now, these signals don't work all the time, but I bear them in mind, and I think they're useful to all of us as we move through the ages. Remember too that over-optimism and excitement will often accompany major peaks, and you want to be careful about joining the party, whereas fear, panic, and negativity is often concurrent with major lows, and that's when crisis can create opportunities. Now, right now, what I'm seeing is hysteria in the markets. I think it's justified in many cases. I mean, we're talking about world security here. We're talking about war issues. We're talking about legitimate supply fears. But I do want to indicate as we move through today's report that this is sometimes the very thing that you'll see when major highs are being struck. So we've got some wild markets going on here. I cannot pretend to predict that I know where they're going or that any of the tools I use will be 100% accurate, but we're going to talk about them and make note of some observations. Herd mentality is always important to keep an eye on. We've come through a time where I think herd mentality is at a new high in many ways. It seems like people grab hold of a certain belief, it spreads throughout society, it spreads throughout politics, and people have a hard time thinking for themselves, and they throw logic out the window and believe in certain issues that really are not logical from a common sense standpoint. I'm going to identify a couple examples of that. Right now, everything's going up. Inflation, inflation, inflation. And when I spoke last to you through a webinar in November, I talked about a convergence of forces at that time. And those forces are still in play, plus more. And one of the forces that I mentioned at the time was monetary inflation. And by this, I mean excessive, unwarranted, unabated, uncontrolled government spending. That's a bit of a rant. But I believe that the tendency of governments to spend money these days on unnecessary support for their populace and to rain money upon their populace. This is unprecedented, and the money creation that is involved with this and the artificially low interest rates supported by central bank accommodation, this is creating inflation. This was a hotbed for inflation to begin with. A dollar started to buy less and less, and now it's even more out of control. So that's step one. Now, there's a lot of factors in these higher prices. It's not just that, but post-lockdown pent-up demand coming out of the pandemic, coming out of a time when people were not spending a lot of money. Now people want more goods and services, and we don't have the resources to supply them. And meanwhile, supply chain breakages seem to be happening all over the place. And there were a lot of links here and there in the supply chains, not so much in the food industry, but in the input industries. Some of them are related to COVID, some not, but these are contributing to inflation. They're contributing to supply shortages of many goods. Importantly, China is no longer exporting deflation to North America or Europe. By this, I mean that we lived for a couple of decades on cheap manufactured goods coming out of China. China could take in raw materials from the rest of the world and use its own raw materials. And China had very cheap labor. China could build factories cheaper than anybody else. And China could load the goods that they produced onto boats and send them to us. And that kept prices down. That actually created deflation, you might say. That is lower prices for a lot of goods. Well, this is over. China can't do this anymore. People don't want to rely on China anymore. Shipping costs have gone up. Wages have gone up in China. It's over. This is a new world we're living in, and we cannot depend on China to export things cheaply to us or as cheaply as before. Meanwhile, demographically, we're into a situation where the population in North America is getting older. There are fewer workers, immigration's down, baby boomers are retiring. People are not motivated to work because they just pay more taxes anyway. And the inflation feeds on itself. So the most recent news in this regard is that CPR workers are talking about going on strike. So we see a threat there. So we're looking at rising labor costs. You see this on the farm as well. And this is part and parcel of inflation. When I spoke to you last and in some newsletters, I've referred to what I think is a profound factor behind rising prices. And that is the great collision between the pro-oil people and the pro-green movement. So there's been a lot of capital moving out of oil. Pension funds, for example, a lot of investors are moving out of oil-related businesses because they think it's a bad thing to do. They think it's immoral to be involved with the oil business. You're supposed to be highly environmentally motivated and not produce oil and instead go for things like solar and electric and that sort of thing. The problem is that the world still needs as much oil as it did 6 months ago, a year ago, and 2 years ago. And in fact, in some cases more. So the problem is that without capital investment, the oil industries have not been expanding in a manner that is commensurate with the demand for oil. And as a result, the oil prices are moving up. We do not have the so-called green energy resources to make up for this. And I believe that this is a great example of naive idealism and groupthink. And that's what got us here. That's what got some of the inflation started with rising oil prices. And now, of course, we have the war piled on top of everything. And with supplies already low relative to demand for a lot of services, including grain and oil, we've got Ukrainian grain cut off and Russian oil supply lines choked off in many cases to the world, whether voluntarily or whatever. And so people in Europe and some people in Canada are sitting down and saying, well, maybe it wasn't the greatest idea to disincentivize and back away from developing our own industry and back away from developing pipelines and so forth, and back away from providing ourselves with our own energy in this country under our control, and instead relying on the likes of Middle East oil and Russian oil. And it's a major, major wake-up call. And again, I believe that part and parcel of this is the result of this groupthink that got us here. In any case, that's a bit of a rant and an opinion piece, but the fact is a convergence of forces have created higher and higher prices. So let's talk more about that. The geopolitical game changer in Ukraine takes the center stage. A quick geography lesson. Notice this map with Ukraine marked on it here, and you can see the central situation in Europe. Europe is this green area outlined here. Here we have the Russian part of Europe, and of course, a lot of Russia's in Asia. Russia has even a greater land mass than Canada. Ukraine is right on the Black Sea, and this is a major hub of grain trading and a highly reliable hub, actually. And Black Sea, the Black Sea area has been a very, very, very busy place for grain marketing and, for that matter, the movement of energy-related materials out through the Black Sea. So the vessels move out through the Straits of Bosporus, which are controlled by Turkey here, into the Mediterranean. Some of the vessels move out the Mediterranean to other parts of the world through the Strait of Gibraltar. Some of the vessels move into Southern Europe, through Italy, through Southern France here. And some vessels go out the Suez Canal. Some move over here to the Middle East, supply countries like Lebanon with wheat. Lebanon is a typical example of a country that's going to be running short of wheat here. And so the Black Sea area here has been critically important and a critical link to grain trading. So with this terrible war, we ask ourselves, first of all, what about the humanitarian crisis? Is this going to get worse? And NATO countries and the West are largely not moving into Ukraine with our military support because people are afraid of a nuclear war. They're afraid Putin will just sacrifice absolutely everything and pull his nukes out. And by the way, I can remember the last big scare in this regard. I think it was 1962 when Kennedy stood up against Khrushchev and disallowed missiles into Cuba. And we were afraid at that time that there could be a nuclear war. And I can remember the fear in my father's eyes in about 1962 as he listened to the news on the radio. Is there a silver lining to the human tragedy of this? I always like to look at tough spots in life and difficult times and challenging times and what seems like horrific times and say, is there a flip side to this? Is there another side to this? And one of the things I can think of and hope that will come out of this is that this could be the end of Putin. We're dealing with a regime here that is not behaving like a country, but instead a crime syndicate. And maybe, just maybe, somebody will, within his group, will take him out. Maybe, just maybe, and hopefully he's digging his own grave in Ukraine. It's a big price to pay, though. As farmers, we ask, how severe will the grain shortfalls be from this, and where will prices go? And we're going to tackle that. We want to look also at input costs, energy and fertilizer prices, and where they might go. I'm going to say a few words about energy today, but I'm not a fertilizer expert. This zooms in on the map, and just for interest's sake, I thought I'd spend a moment with it because on the east side here, you have Luhansk and Donetsk, which are provinces that are oriented more toward Russia. Anyway, there's been fighting going on here for quite some time. Putin took over the Crimean Peninsula, an important area of the Black Sea down here quite some time ago. And I hoped right up until a few days ago that Putin would say, okay, I'll pull my guns out if you won't join NATO and if you give me Crimea officially and formally surrender these eastern provinces here to me. And it doesn't seem like that's going to happen, although who knows, it could get bad enough that Ukraine has to agree to that. So anyway, we've got a humanitarian catastrophe going on here. We've got movement of grain and other commodities from Ukraine halted. We've got movement slowed from Russia. Russian ships are pulling out of ports on the Black Sea with various, loaded with various products. And so there is some movement out of Russia, but of course, a lot of people are banning Russian deliveries. And the movement has slowed down. Ukraine's ports are totally crippled, totally out of commission right now. You can't move anything out of Odessa here. You can't move anything out of these ports along the Sea of Azov here. So Ukraine doesn't want to move anything anyway. You can move about 19,000 tons a day by rail into Eastern Europe locations out of Ukraine, but The Ukrainian government has said, we got to keep this food at home. Ukraine is a large global supplier. This gives you a picture of the exports. They're number 2 in world barley exports, number 4 in corn, number 1 in sunflower oil, 3 in rapeseed, and the 3rd largest in wheat. Ukraine's exports in a normal year would look after a good 12% of the global wheat exports, 16% of corn, 18% of barley, 19% of world rapeseed. Total corn exports, 31 million tons in 21-22. For just to show you the sheer size of these exports, Canada in total produced about 13.6 million tons of corn last year. So that's a significant volume. Over half the world's sunflower exports come from Ukraine, and most of the rest from Russia. And the news Wednesday was, as I mentioned just a moment ago, that Ukraine itself is voluntarily banning its exports of barley, oats, certain other commodities anyway. So that's pulled out of the world grain markets. Exports from Russia, major wheat exporter, 33 to 40 million tons a year versus 25 million from the US on average. Russia is bigger than anybody else in sunflowers too. Now, some of this grain is going to keep moving. Fertilizer moves from Belarus, which is controlled by Russia, mainly potash, and Russian nitrogen forms a major part of the global supply, about 11% of global ammonia. And this would normally move through Ukraine and out the port of Odessa. Well, that has ended. Natural gas, as you know, moves from Russia to supply much of Europe. Here again, you have this group thing with the environmental sensitivity in Germany, for example, the industrial powerhouse of Europe, relying on Russian natural gas. Germany has even been decommissioning its own nuclear plants, which it could have used to supply electricity, and instead turning to Putin for its supply. So this is turning out to be a very grave error. Oil from Russia and its allies moves to various parts of the world. And Canada, of all people, we have imported oil from Azerbaijan, which is near Russia, via the Black Sea, from the Caspian Sea area out the Black Sea. Unbelievable. Farm machinery and aerospace components are our main exports. So again, I'm talking about this groupthink error here. These points being made, let's talk about wheat for a minute, and I'll show you an interesting graph here, because Russia and Ukraine supplies are critical to the global wheat supply. And the two of them account for almost 30% of global exports. And as this graph here shows, Canada is a significant exporter. Next, you've got Russia, well above Canada. And now here you've got Ukraine. And if you look at Ukraine here for this year, 2021, 2022, Ukraine was all set up to sell more wheat to the world than Canada because of our crop shortfall. And then you have the United States, an important global supplier as well. But again, less in recent years than Russia. And you can see both Russia and Ukraine have been climbing in terms of their exports. The countries are becoming increasingly more productive and increasingly with better yields and so forth as they come out of the dark Soviet era. And now Russia is plunging itself back into that, as they seem to be building an iron curtain around themselves. Now, one big question people ask is, are the Ukrainians going to be able to get a crop in? Are they going to be able to have the inputs there? What's going to happen with 2022 wheat, corn, barley, sunflower crops, and so forth? And if they do get crops in, are they going to be able to get them out? And I think this is a very, very serious issue. These people are going to try to plant their crops, but how serious is this invasion going to impair them? Now, if you look at this map, these colored areas, these kind of reddish tan colored areas, are areas the Russians are controlling or advancing into at this time. Here's, you can see Kyiv, the capital, where Russia is trying to surround it. And you can see the southern areas around the Black Sea. This is a huge agricultural belt, though, that Russia isn't into yet. So there's a good chance that people at least try to put a crop in. if for nothing else than to feed their own locales. All this seems bullish, but I keep looking at the markets and wondering if corn and wheat markets, for example, might be peaking now or soon amid the bullish news. Not saying they definitely are, but they might be. I always want to stay open to that possibility because the futures markets are behaving as though they don't want to go higher. Now, maybe that's not saying anything about the physical markets, but that's what we see today. Regardless, however, of where the futures markets go in the next several days and weeks, where we are today with the gains we have seen with so many commodities, we're into more inflation. This has added to the inflationary environment we're in. And with delayed reactions, the high grain and energy prices are trickling down toward the store shelves, slowly and surely boosting consumer prices. This graph shows you the consumer price index for the United States. Now, when COVID first hit, I thought we were into more deflation. You can see the red arrow there, early 2020. And I thought we could be in for several more months of deflation and declining economic conditions before we get into the inflation caused by the excessive government spending. So that brief deflationary period saw prices for a lot of commodities, goods, services plummeting. But suddenly they made an about face. The government rained money upon the people, the markets turned around, businesses proved to be a little more adaptable than anticipated, and bang, we got into an inflationary phase. And now here we are. So the Americans are up over 7% at the retail level. And when the news is out for March and April, it's going to be even higher. And Canada's chart is going to look similar. So moving on now to the stock markets. I always keep in mind what the big stock market indexes are doing, because I question whether shaking the world up this way is going to allow the stock markets, including the big powerhouse of the world in the stock markets, the US S&P, is it going to be able to keep trending higher on this? Now, some sectors are still trending higher and some aren't, but on average, as expressed by this big picture index here, is it going to keep trending up? So in 2000 to 2002, we had the dot-com bubble. We had a bear market for 2 or 3 years. In 2007, 2008, a bear market for a little over a year during the financial crunch. When COVID first hit, we just had one brief downward swing. I thought we were going to have another one, but nope, the markets got themselves together after the COVID crunch and roared higher to new all-time highs. And so here we are now. So right now, the stock markets are showing some pretty serious jitters. I'm going to be watching them, and if they fall below the recent low of 2 or 3 weeks ago, that'll probably be a sign of capitulation and the inability of these markets to keep holding up. So I'm going to be very careful with my portfolio. Now let's talk about crude oil, the great granddaddy of the global commodity markets. And you can see the boom peak here of 2008. Everybody was bullish. You could walk down the business aisle of Chapter's Indigo store and every book was on peak oil. The oil market was going to go higher. So that was obviously sowing the seeds for lower prices. What we didn't know was that prices would actually go negative in March of 2020 during the COVID crash low. Well, when you get a market going negative, that's really something. That is an extreme, to say the least. Around that time, a friend called me up and he said, if you believe anything about your contrary opinion theories, you better do some buying in the oil business. And certainly oil stocks and oil commodities and everything have gone higher since then. And now we've gone far higher than even I would have thought, and I was bullish just because one extreme creates another. We've gone higher than I even thought by far, and over $130 earlier this week before turning down yesterday to under 110. So that shows you a lesson learned. An extreme in one direction will often produce an extreme in the opposite direction. Is this bull market over? Hard to say. It's certainly very mature. It's getting old. It's into its upper realm here. It very well might, but you still can't rule out a move to $150 or so, taking out the previous bull market high. Now for gasoline, the uptrend has been accelerating, and you do see a new all-time high with this particular market above its all-time 2008 peak. So it too has come out of the extreme COVID crunch low with an elastic band, like an elastic band in the opposite direction, a new high this week. This chart is speaking loudly to three important things. Number one, more inflation at the consumer level, because this is going to percolate down to continue raising retail prices. Even if gasoline at the consumer level doesn't go any higher, the cost of trucking and everything else gradually gets baked into more and more consumer items, rising labor costs and so forth. So this is telling you something about where inflation is going to be 2, 3, 4 months down the road. You're looking at high costs of fuel on the farm, and you're looking at high value of crops used to make ethanol. And on top of everything else here, we've got a weak Canadian dollar, so the price of gasoline looks even higher in Canadian terms. And then, of course, we've also got the carbon tax, and that just adds insult to injury. Diesel looks similar, new all-time high here on the futures side, and expressed in Canadian dollar, the price increase is even more dramatic. Now, I do see possible reversal action on these energy markets. So I think if you buy now, you're coming late to the party, and that applies to energy-related stocks. It applies to futures. It applies to booking diesel supplies on the farm and so forth. That said, could we go higher? Well, we could if things intensify and worsen in Ukraine. So maybe it's time to get an electric vehicle, hey? Well, maybe not. Everything that goes into making electric vehicles is going up too. Nickel is one of them. A lot of people don't realize that a lot of raw materials are required to produce the batteries and other components for these electric cars. So the price of nickel in one day more than doubled on the London Metal Exchange recently. And this was caused in part by a margin call squeeze. Apparently a Chinese company was hedging its nickel needs. In other words, like they were selling short the market. They were hedging instead of selling the actual commodity. And they couldn't meet their margin. It was just a few $1 billion. So it sent the London Metal Exchange people into shutting down trading. That's just one example of the world market chaos that's going on. It's not just happening in the grain markets and in the energy markets. We're probably going to see more of this type of chaos. Through all this, one place that attracts capital is the US. People go to the US currency. It's not the greatest currency, maybe. You might call it the healthiest horse in the glue factory, because all currencies are losing buying power as we get into inflation. But you'd rather be in the US dollar than in the Argentine peso or the Russian ruble, of course, and even the euro. And so the American dollar, the past few weeks, has trended higher, as you can see on the chart where I'm showing you on my cursor. Now, bear in mind that during the greatest historic commodity bull move of the past many years, the US dollar was weak. Previous commodity boom highs came with severe weakness in the American dollar in 2008 and in 2011, 2012. The US dollar is not that low anymore. So if you want to see one factor that could terminate the commodity bull markets, or at least cap these bull markets, watch the American dollar. If it keeps moving higher and gets up into this 100, 105, 110 area here on the chart, then that is something that could cap the bull market. So I'm watching that closely. The stronger US dollar of the recent little while is also weakening the Canadian dollar. Usually when you get the energy markets going up, the Canadian dollar market is going up with them. Not so this time around. We do not have a big energy market on the go. The Canadian dollar has failed to follow the energy markets up. This weakness in our currency is good news for our crop prices, but of course it's bad news if you're buying inputs these days. People ask me, what do you think, John, about the Canadian dollar? And I'm mixed right now. I'm kind of sitting on the fence with it, no positions. One thing that interests me is that when you get high grain prices like we have these days, it's hard to put grain through cattle and make a profit. And we've got a huge disincentive to expand the cow herd throughout North America and in Australia and globally here. And at around $140 these days, the big benchmark American cattle futures are a long way from the 2014 peak of $170. So while a lot of markets are challenging those record highs, cattle are not. Cattle are a long way from that 2014 record high still. And you want to remember that livestock markets tend to do what grains do, but with delayed reactions. So if that happens this time around, there's more upside room in this cattle price cycle, especially after the recent herd reductions. We've had a cycle high due in around 2023, 2024, maybe 2025, centering on 2024 for quite some time. And everything you see today continues to point in that direction. Barring a major global economic wreck, the cattle business right now is reducing itself into a bull market position for 2 years down the road. And this shows you the smallest beef cow factory in this country since the 1980s, early 90s. And when you reduce the beef cow inventory that much, you're reducing the future supply of cattle and of beef. A quick comment on fertilizer, just a couple of charts here. The one on the left shows you nitrogen in the United States and how it has exploded in a near vertical rally the past few weeks. And the graph on the right shows you the weekly average retail potash price in the United States. This is for the week ending March the 4th. And you can see that red line and how high that is, more than double over where it was in 2021, 2020, and the 5-year average. So I'm not telling you here anything you don't already know. Fertilizer company stocks, meanwhile, are setting new highs. World commentators are wondering whether the US will get the full corn crop fertilized. We know there are a lot of people, a significant percentage of growers in Western Canada who do not have their fertilizer needs booked and in position yet at this time. So this could be a serious issue here, and some people could be in tough spots. And we might see some acreage shifts as the result of this. Interest rate wise, with inflation going on, it's pretty well a done deal that interest rates bottomed in March of 2020 and during the next several months, and that they're slowly plugging their way higher. Now, this shows you a US interest rate TBF for short-term rates. That's the symbol is TBF. This is a reverse bond market fund. So people who think interest rates are going up can stick some of this into their stock market portfolio. And if rates go up, then this TBF thing should also go up, somewhat mimicking the, but not exactly mimicking the rising rates. So this investment vehicle follows interest rates in a general approximate manner. I think it is important to set up investment portfolios and borrowing strategies for at least steady and probably higher interest rates over time. Quick look at Canadian farm financials. Your assets are going higher. They tend to do that in inflation. Liabilities tend to move higher as well. But right now, liabilities are not moving up quite fast enough to keep up with the rising assets. So you've got some tremendous equity. And a lot of farm businesses and a lot of farm families are sitting on a lot of paper money if you tally up your assets and subtract your liabilities. Some aren't, of course. This is widely variable, but overall across Canada, this is quite an amazing picture. And I think it's critically important to try and maintain this equity and not let it slip away with several years of losses. So that's just a message these days that I think is important. Key idea at the bottom there on the left, which I just popped up: take steps to protect your equity. One way to protect equity is to focus aggressively on the margins. And if you're like this farmer who I'm quoting here, who said, I like the paycheck for my wheat and canola, but I'm sending big checks to my suppliers too. And he says, I'm having trouble getting used to the big numbers. And I think during times like this, that it's important to take a look at some of the prices that are on the table, take a look at your cost of production and your input costs and so forth. And where there's a profit margin, that factors heavily into your decision-making process, quite possibly even more so than where you think the markets are going. So you make a lot of your selling decisions and a lot of your input buying decisions based not on your outlook, but on what works for your farm's bottom line, particularly for your margins. It's all about the war right now, but it's going also to be about the weather soon. A recent research report suggested that the current drought across the western US, portions of Western Canada and Mexico is the worst in over 1,000 years. Researchers found last year's dryness was the tipping point, making the current drought worse than the last so-called mega drought that happened in the 1500s. Now, of course, it's going to take multiple wet years to fix the moisture deficits. And I'm not a climate change alarmist by any means, but I do think we're going to have some weather vagaries. And if nothing else, even if crops throughout North America turn out great in the end, there's going to be some nervousness in the meantime. And if you look at the red areas and the tan areas on this chart, you can see that they constitute a sizable amount of the North American growing region. So I think there is going to be some tensions, most specifically on the hard red winter wheat belt soon, particularly around Kansas. Closing remarks for part one, the intro. First of all, the war in Ukraine remains a fluid, unpredictable situation. And Russia's shifting status versus Europe and America is adding an entirely new, different dimension. And Putin and his friends have the Russian people propagandized into believing that the West is after them. And so we're building this major standoff, and between Putin and the United States, they've got the biggest nuclear guns. And this is a very serious, unpredictable situation. Regardless of where the futures markets go in the next few weeks, higher, lower, sideways, there's still more reverberations on the way for input costs, wholesale and retail prices, labor costs, and you've got some tough decisions ahead of you. This is not going to be an easy time to do business. Remember that this is a rare time in history when interest rates are far, far below inflation rates. I mean, the Bank of Canada just raised its interest rate by 0.25 basis points to 0.5%. Its benchmark rate, when inflation is raging like it is. Whoop-de-doo. What is that going to do to control inflation? Nothing. But there's got to be further steps ahead. I mean, central banks are going to be worried about causing economic problems, but what can they do with inflation raging? Which is more important? Conventional energy was overstretched to the downside in 2020. This was stretched to the downside with groupthink, with excessive bearishness, the whole works. And so now we've got a record-setting bull move getting overstretched to the upside. Oh, how the markets repeat themselves throughout history. Somewhat the same for grain markets. Everything was falling 2 years ago, and now everything's been rising. But I suggest you stay open for surprises, both bullish and bearish ones. We've got war now, we got weather later, we got lots more volatility coming, but that doesn't mean the markets are going to continue to rise parabolically. From March of 2020, we had an everything rally for commodities, stock markets, just about everything went up. There may be more fireworks ahead, but the easiest gains for this increase, the easiest gains for this big 2-year everything rally are over. And remember, as we move through this period of high prices, this period of extreme high prices and surprising high prices, that the higher the mountain, the deeper the valley. That is part one. Please make note of some questions now, and you can put them in the Q&A, use the Q&A button there and send them off to Trevor, and we'll cover them at the end. That was part one. Let's now take a look at part two. An acreage survey was recently undertaken by DePutter Publishing. Thanks to those who participated in it. We're going to look at the acreage survey, talk a little bit about the markets, and describe our positions in the markets. First of all, the acreage survey. This was published in last week's DePutter Market Advisory newsletter. Again, if you didn't get that, talk to your Syngenta rep. If you did get it but didn't open it, you'll see this chart. And we extrapolated the results of our survey to get an idea of where total acreage might be across the 3 prairie provinces of Western Canada. Now, you got to be careful extrapolating what we see in our survey, but we've done it here anyway. And I don't by any means want to say that this is where acreages are going to wind up, but we do have some insight. So first of all, people answering our survey told us that they were going to cut canola acres by 2.6% from a year ago. Most people said their acreage mix was either carved in stone or determined for the most part. So in the end, who knows, the current situation, the mix of high prices for canola, but the difficulty of paying for and getting some of the inputs required to grow this crop could move the needle on canola, probably more to the downside than the upside. So it's still uncertain. All wheat up 10.2%, of which spring wheat came in with an 11.6% increase. Durum up 6.3%, and winter wheat already in the ground, up almost 14%. Here's a big shift. Oats up 44%. Now, we've seen some other surveys that are up more like 10 or 15%. But regardless of the details, oat acres are going to be up sharply. Here we have a very low input crop, and people are looking at extreme high prices for both old crop and for new crop oats. And there were some great forward contract opportunities throughout the prairies over the course of the previous few weeks. Barley down about 14%. People for their cereals are leaning more toward oats and spring wheat. Flax up about 6%, small sample size, not sure that'll come through, but if it does, it's not a big enough increase to wreck the flax market by any means. Peas down 11%. So if you were thinking of putting fewer peas in, both greens and yellows, down, but mainly greens, could be a contrarian play to actually put some green peas in. All lentils up 4.5%, equally split between green and red lentils in terms of the percentage increase. Canary seed down slightly, small sample size, kind of uncertain about that coming through. Fava beans down slightly, chickpeas up 19%. Interesting thing there. Mustard up at least 56%, no surprise. This has been one of the hottest markets, and we're coming off a few years of low acreages. I'll talk more about these crops later, but that gives you some insight into our acreage survey and a bit of an overview. Bear in mind, we will take questions about this at the end. I want to talk about corn first of all, because corn is the engine of the feed grains. And the reason that you're looking at higher barley prices today, or barley prices at least holding up near the recent highs, is because of corn. Feed wheat is strong. A lot of this can be traced back to the height of the corn market. And you can see the upswing in corn coming into early February and then proceeding on into late February and the most recent rally caused by the war. So the old crop May future may actually be peaking with the implications of the war fully priced in. I mean, this market has come from 550 to over 750. It has challenged its all-time high of 2012. So there is a possibility that the corn market is topping out here. The December future has made new highs the past few days, over and above the high of last week recently. So the December future is doing well too. So here you have new crop prices. They're about $1 lower than the May, but we're looking at inversions like that in most crops. And so it wouldn't be surprised if the December future has got most of the bullishness from the war priced into it too. Now, I don't see absolute concrete signals that these markets, the old and new crop corn futures are peaking, but I do think that there's a possibility that they're coming into some topping action now or soon. And one reason I say that too is that South American corn production is still looking big, really big. Even with some crop losses, South America could still produce a record large crop this year. China and others are going to turn from Ukraine to South America. South America's crop isn't coming off yet. So if they're turning to other countries, they've got to come to the US first. But this is something that could start hitting the market in April, May, and June. So remember that while South America's got a problem with its soybeans, it doesn't with its corn and could come to the rescue. I also think US farmers are going to manage to put a pretty decent crop in the ground, notwithstanding the fertilizer issues. There will be some cutbacks due to fertilizer shortages and costs. And US production will no doubt be in doubt during the spring and summer, and there's going to be some nervousness. Could cause that December future to go into some spasms yet. But in the end, I see a pretty fair chance of a US corn crop of at least 14 billion bushels, if not 15 billion, coming off this year. And that is shown by the green bar. So there's still a good supply of corn in the US, potential for a healthy crop in 22. And that could limit further price gains, could keep the corn market under some control here during the war throes. So we get to barley, and you can see the record high prices posted for barley over the course of the past 2 or 3 months. And we're still looking at some phenomenal barley prices, $8.50, $9 for old crop in some high paying areas, new crop $7.50 to $8. I was looking recently and saw $8.50 to $8.70 new crop barley laid into Lethbridge area feedlots. How did barley get here? Well, of course, China was contracting heavy volumes from Canada last spring. They actually were starting in March to do that. And we saw some $5 new crop prices out there that looked phenomenal at the time. But then drought struck, slamming our crop from over 10 million tons to under 6 million. Farmers got stung with forward contracts, right, left, and center. Corn became the feed of choice. Feedlots turned to imported US corn. And guess what then? The cap comes, or the crowning thing, corn gets more expensive. And so what you've had here is domestic barley prices well above offshore values. Domestic barley prices in Canada have been some of the highest barley prices in the world over the course of the past 2 or 3 months. And it's not just barley, feed, everything feed. Anything that go into livestock feed has been in demand, including feed wheat and feed barley, feed oats, feed grade pulses, you name it. And feed wheat values have been supporting milling quality wheat prices in some of the high consumption areas. And during the past several weeks, $12 a bushel for feed grade wheat has been common. And I actually saw a trade at 13.75 for feed grade wheat in Alberta on Monday. And so this graph shows the feed wheat prices. One quick comment on this graph, you can see the prices at the top lead into feedlot heavy areas, and some elevator bids are way under that. And some of these bids are actually stink bids. And here's an industrial user though in Belle Plaine. But I think you all know this, but during times of volatility like this, it's even more important than ever to shop around and seek out the best bid because they are so variable. As far as Ukraine is concerned regarding barley, the country grows about 8 to 9 million tons normally. That's not big compared to the European Union, which can grow 50 to 60 million tons. Nonetheless, Ukraine is still an important player in the global barley market, and so is Russia. We're 80 to 100% sold on old crop barley and watching corn. What the situation in Ukraine has done is raise prices for barley around the Black Sea and in Europe, but it's still only coming up toward the higher, relatively higher price of barley in Canada. So it's not a major factor for old crop barley. It's a supportive factor because it's sending corn higher, but it's not a truly major factor. And that's why barley has simply stayed where it was and hasn't gone a whole heck of a lot higher over the course of the last 2 or 3 weeks. Now, I think new crop does have upside room due to the war, and from the smaller acreage revealed in our acreage survey as well. As if people come through with their plans and grow even 5% less barley or more, as was suggested in our survey, that's not going to replenish the empty cupboard by any means. So remember too that your new crop barley is going to be coming off when corn is still trading at old crop values, because corn in the US doesn't start coming off until October. And by the time, in some places, lots of places, November, and by the time you get it up here, it's after that. Well, meanwhile, you've got new crop barley available during the time of the old crop corn market. So these factors are telling us we don't need to push prices too aggressively for barley at this time. Now, mind you, it's pretty darn tempting to get 15 or 20% on the books at $8 a bushel. I mean, that's a good price. Malt barley is not following the other grains higher either right now, although malt barley is, very respectable by historic standards. We think China is going to have to come here for malt, if not from Europe, then Canada. And they have been a buyer of French malting barley in the past and could be turning to Canada for more this year. So the situation opens up some questions with respect to new crop. And although we are supportive of having 15 to 20% of most new crop grains on the books, it's not a dire emergency to go out there and sell it now if you haven't done it yet. Now let's talk about soybeans, because beans have a big impact on canola. The soybean market reversed in bearish fashion. It's a typical bearish reversal action. The 2 days, the last couple of days in February, right when the war was announced and when the Russian troops were advancing. And I looked at that market at the time and I said, how in the world can this be? This is flat out bullish. But interestingly, the bean market has still not gone above where it was when the war was first announced. And the chart pattern looks somewhat toppy. And this is coming after a $4 to $5 surge from the fall lows. So I see one market here that I want to tell you seems unable to go higher despite bullish news. We don't know whether that is definitely a signal of a top or not, but it could be. This is typical of what you see when a market is topping. Same for the November future. You see that chart pattern there? It has been unable to go higher the past 2 weeks, despite all of the bullish news in the world. And so I'm thinking the soybean market cannot be depended on to drive the canola market higher. Until soybeans overcome that bearish reversal action on the chart, I'll be skeptical about beans being a bullish driver for our canola market. Another important aspect to mention here is that South American production is down, but that's not moving the market higher either. We have a shortfall in South America, although not a total wreck. These last 3 bars here show the crop estimates issued in December. People thought it would be a record high, lower in January, more dryness in dry areas and too much rain in other areas, lower estimate in February. And I don't have it showing here, but a report yesterday lowered the soybean crop in South America another notch. So it's going to be the lowest crop since 27-18, the crop that came off in the late winter of 2018, early spring here. Now, the market should be going higher on this news, but it isn't. So to me, that's a sign of poor tone. Now, the soybean market also has an excuse to go higher because Russia and Ukraine are huge into sunflower oil, and sun oil exports out of Ukraine have stopped, and some countries won't want to buy sunflower oil from Russia. But this is affecting bean oil and not the soybean or the meal. Bear in mind too that the Americans are probably going to produce more acres of soybeans this coming year. And so all in all, we could be putting a major top into the soybean market at this time. Now let's look at canola. Unlike beans, canola has moved higher the past couple of weeks. This is shown on the daily May future here. So we have a bull market still in place. The May future has gone from $600 on the lower left of the chart here, all the way up to well over $1,100. It was trading around 1120 when this graph was made, and that's a long way. So this bull market is getting old, but I do not see bearish chart reversals on it as of today. It has set a new high with the invasion of Ukraine. It's doing what it is supposed to do. So we do not have a signal of poor tone like we have in the bean market for canola. If we stand back for a 5-year perspective, likewise, we bring in the view of just how high this market really is, from around $450 during the COVID crunch 2 years ago to over $1,100 today. This has been a bull market par excellence. And on this weekly chart, as with the daily chart, we still don't see a bunch of negative chart patterns to suggest the bull move is totally over as of today. This is the strongest sector of the soybean complex, soybean oil. Soybean oil has actually been low priced relative to canola, so it has done some catching up lately. So that bull market still seems to be getting along. Around the world, global veg oil users are scrambling for alternatives to sunflower oil from Ukraine. They're scurrying for alternatives from palm oil, and I'll show you that chart in a minute. So soybean oil is a logical alternative, and all of this is happening when the world wants to use more biofuel. So again, soybean oil might very well be peaking on the bullish news. Look how far it's gone, but we don't have the same kind of negative or cautionary signals that we have in soybeans. Rapeseed futures in Europe have been part of the bullish upswelling in the veg oil market. Europe needs its rapeseed oil to feed its biofuel plants. Its production has been declining, but winter seeded rapeseed in Europe is up 3 to 7%. That's in the ground. That'll be harvested before too terribly wrong. So there'll be some relief in Europe in the summer of 2022. Here again, though, this kind of looks like the final leg up in this massive bull market, which obviously has come a long way. Now we look at palm oil, the biggest veg oil of all in the world. India is pleading with Indonesia, please supply us more. And when we look at palm oil, I do see a possible top on this 5-year chart, because the nearby future recently went up above this 8,500 mark, and now it's down around 7 here. You don't even need to know the units of that. The fact is that this is a massive bull market, And the latest information here is that the market is no longer moving to a new high with the Ukraine news. So we might be looking at a blow off top there. Perfect storm has occurred for the oilseed markets in general and canola in particular. The drought in Canada, first of all, came along and slashed production here. This happened at a time when biodiesel demand was already growing and the biodiesel value was being lifted by crude oil and gasoline, and all the more so now. Palm oil production was set to fade, and a mega rally occurred in palm oil as world users wanted more. India is a big user, and India was hungry. And then weather woes came in and clipped the South American soybean crop, and that added more fuel to the fire. And now you got the war in Ukraine slamming the door on sunflower exports from Ukraine. So a perfect storm for canola. Now we all know perfect storms don't last. This market could top any day, but right now, like I said, I don't see the signs all coming together to pull the pin for those who have a few tidbits of canola left in the bin. We all know old crop stocks are tight. We all know the pipeline's going to be empty coming into harvest. The big question really is this market high enough now to account for all that? At $25 to $26 a bushel, maybe it is. You know, it's interesting, as the market rises, people like round numbers. There's people now talking, well, maybe I'll sell what I got left at $30. Who knows? This is a wild market. I'm not going to say it can't get there, but I suggest you not ignore chart signals once the futures markets for the various oilseeds fail to keep rallying on bullish news. Looking ahead for the marketing year of 2022-23, our stock's going to be replenished, not easily. If you look at the estimated acreage here, the DePutter forecast in blue, the Agriculture Canada forecast in tan there, both down from last year, on the high side of normal, but we need all the acres we can get to supply the world with what it wants. And so we do not see the next marketing year building a surplus. So we don't see the need to rush new crop sales right at this time, particularly in the absence of chart signals suggest selling. We did advise starting some sales a while ago, and that looks like it was premature, but we didn't know there was going to be a major war in Ukraine either. This shows you the November future and what it's been doing lately. It's way below the old crop futures too. Once again, this is a recurring theme of this event, a recurring theme of our newsletters. New crop prices are way under old crop. And I'm thinking of some of the turmoil in the world is going to have more of an impact on old crop values or on new crop values than old crop before it's all through. People are going to do everything they possibly can to avoid buying commodities at the high old crop prices because they can see that new crop bids are lower than old crop. So for canola, we're 80 to 85% sold on old crop. Some followers, most of you perhaps, will be finished. But for those not, a green light is on to finish sales, but no formal recommendation has been issued. We're sitting at 20% sold on new crop. Obviously, that's too much. We wish we hadn't pulled the trigger, but based on our disciplined incremental selling strategy, we did sell some new crop earlier, and now we're waiting for reversal action on the November canola chart before selling more. Again, you've got the Q&A button there if you have any questions. Now, if a grain market had an excuse to explode if it was wheat, with the schmozzle in Ukraine, and indeed the market did explode. The Chicago market soared to a new all-time high, wiping out even the great mega bull market peak of 2008. And you know, I thought that mega peak for wheat in 2008 would stand for many, many years. But we have a situation that has rocked the globe here, and this chart shows us that. Now, interestingly, however, the arrow shows where the nearby May future closed yesterday, and that was around $12. And this market suffered a major bearish reversal. I'll show you the daily charts in a minute. So there is a possibility that the futures market for wheat got high enough to account for the problems in the world and is now in the throes of a violent, volatile kind of topping process. This shows you the Minneapolis market. It got up to almost $12 earlier this week, so it did not take out its 2008 spike high. Now that 2008 spike high was a bit of an artificial type of rally. The Canadian Wheat Board was short. It happened more in the futures markets. You didn't really see cash prices get as high as futures and so forth. So if you took out that 2008 spike, then you could say, okay, Minneapolis wheat is at a new all-time high. And this market also has made a major move from a low of under $5 in 2019 and 2020. It more than doubled, hit almost $12 this week, like I said, and it too has turned down the past couple of days. This shows you the daily futures. And look at the dramatic downturn the past couple of days. This is looks to me like a market where there was some panic short covering by some big merchants that got caught short. They had to buy at any price. The market's locked limit up. They finally got out, and so the market is reacting. And so the physical wheat market might not be changing as much as futures because commercials didn't follow up the futures with commensurate gains in the cash markets, and they might not be falling it down either. But regardless, this is the kind of action that you tend to see on a chart when a bull market is getting old and into its final throes of topping. I have no idea whether the final top is in yet, but as a chart watcher over the years, I'm just telling you what I see for what it's worth on these charts here. This shows you the cash markets. So from a range of, around $6, $7 for the most part, we were looking at $12 and $13 recently as wheat prices from the Peace River District to Saskatchewan to southern Manitoba flew to new highs for free market times, post-wheat board times. Bids have been extremely erratic. Basis levels have been varying widely. Right now, they're mostly, the basis is mostly lower. I mean, a lot of companies lowered their basis as futures were soaring because they didn't want to keep up with the out of control futures markets. But we saw some number one CWRS 13.5 trade at 14.50, and I think there were cases more. Not sure whether $15 traded on the prairies, but I think it may have in some individual circumstances. We saw some CPS bids even at 14.50 at some locations. And here again, this is another market that's inverted with new crop around 12 to 13 to 13 and a quarter bushel. Now, things are lower now today with the futures market. Wednesday saw most bids down hard. And I think that futures are down lower again today. So you might look back and realize that you saw the top in the wheat market over the course of the past several days. How about new crop wheat? Our acreage survey uncovered more acres. The blue bar shows this. Acreage will probably be on the high side of the past 20 or so years. It could rank near the big years of 2019, 2013, and 2006. So that's fine. The world is going to be able to eat up our wheat. Hard red spring wheat has a near empty cupboard coming into the upcoming crop year. And there will be a world market for new crop wheat. But again, new crop is way under old crop. So I'm wondering if maybe new crop has more upside potential than old crop. There's a few countries in the world that have only got about a 1 month wheat supply, but most importers of wheat have a 2 or 3 month supply, so they can wait for some winter wheat to come off. And what we see in Kansas and the southern U.S. when the winter wheat crop starts to come off in June, that'll give us some indications as to where the spring wheat market might trade when it comes off later on. So again, that's the new crop side of things. For old crop, 80 to 85% sold. I wish in a way I could say, well, I didn't advise a single sale until, a week ago. But the fact is here too, we follow an incremental sales strategy. And so we held one increment back. We felt prices were so good on previous occasions and during previous rallies that they were just too good to pass on. And now bearish chart reversals imply a top may be in place, although not all merchants are actually following futures down as hard as futures are falling. So cash markets are widely variable. And I put out a bulletin yesterday suggesting that the green light is on to make a sale. It's kind of elective as to whether you actually want to follow that or not, because I hate selling into a hole. But I thought to myself, look, I can't let bearish chart action like that and the inability of a market to keep rallying on bullish news, based on everything I've learned the past 40 years, I can't sit here and say, don't sell a single kernel, because fundamentally this market is going higher. I could look back a year or two later and say, where were you, John? You saw your old indicators that you've got in your toolbox and didn't respond. So that's what we're doing with wheat. I think you want to mark on your calendar late April, early May for possible problems in Kansas. And winter wheat acres are set, but spring wheat acres could still rise above earlier expectations in Europe, Canada, and the US. But again, I don't think that's a problem. The wheat market is not going to sink forever. You're going to have demand for your new crop wheat. Okay, next up, we've covered wheat here, and we're going to move on to durum. And here's a situation where stars become dogs, dogs become stars. I've said it 1,000 times, and durum was a star. This was one of the biggest bull markets of the 2021-2022 marketing year until recently. Durum got top honors along with oats. Those two crops were among the biggest price gainers during calendar year 2021. So they exited the year 2021 with tremendous gains. And a lot of people are thinking, well, durum was at $20, $21 earlier. I'll hang on to my durum until it gets back there. But that was a pretty phenomenal outlier of a price. And we've talked about North African demand in the past and weather problems there. And North Africa has, in fact, come out with some tenders recently. But it seems that the grain companies accumulated enough supplies to meet those tenders, both in Canada and in Europe. They had durum supplies in hand, so they met their tenders with their long positions, or a good portion of them, of this grain was met with grain that merchants already owned. And by our calculations, Europe, including Italy, has enough durum to get through to new crop. They might buy some from Canada. Europe will be looking around to keep their warehouses full wherever possible. But on the other hand, 2022 is highly discounted to the high old crop market. Now, I think eventually the high prices of durum have done a good enough job coaxing enough production into place here, if weather is decent, that we could see durum trade at parity or less than CWRS. And we're just 2.5 months away from the European, Mediterranean, North African harvests. And there's limited demand for Canadian durum right now. There might be some needed to fill the tenders, and that'll translate down in Saskatchewan prices to around $17, $7.50, maybe $17.75. But time is ticking away, and you're staring an inverse in the face with new crop durum being way below old crop. So if you're looking at your current durum prices and thinking you're going to get $20, I don't think it'll happen. It's just, there's no reason for durum to follow wheat up or the other crops. Ukraine and Russia aren't involved in this market. And you might see $18. Good pretty decent chance of 17 to 1750. But again, the clock is ticking. Now let's talk about new crop. It's deeply discounted to old crop, as mentioned. It could come up to meet old crop or at least part way. So I say that partly because Europe is looking at about 7.7 million tons this year, and that's a good crop, but not a huge surplus. And so the Europeans are going to need normal amounts of durum from Canada. And the drought in North Africa is going to cause more demand for Canadian durum. And Morocco, Algeria, and Tunisia would be buying more durum right now than they already are if they didn't look at the market and say, well, I can get new crop for $3 or $4 a bushel less than old crop. They would probably be accumulating more. We think Morocco is going to, Morocco on the map here, under 1 million tons versus 2.5 million last year and 750,000 the year before. Algeria here, 1.5 to 2 million in their production. That'll be down from 2.5 million last year and 3 the year before. And Tunisia, this little country here, a smaller producer, significant user and importer, but a player, smaller crop. Then you go north across the Mediterranean, and Spain is dry, and crops look okay in France and Italy. So again, I think that the play here is on new crop durum more than old crop, and I would be very careful with old crop. We're 85% sold, and I wish I was at 100%. Have realistic expectations. $18 is possible, but a stretch. Don't bet the farm on it. 1750 might be the best to expect, possibly 1775 from some buyers. The clock is ticking. Beware the inverse. No rush to make new crop sales because it's way under old crop. Use weather worries in North Africa and in North America too. Our durum crop isn't even in the ground, obviously, yet. And lots of you have snow, but it's still dry in the heart of the durum production region. 14, $15 for number 1 or number 2 quad would get us more interested in selling some more new crop durum or starting sales if you haven't sold any yet. So that's durum. Moving on now to oats, biggest bull market in history here, more than $2 above the 2014 peak. Top prize in calendar year 2021 among US-based commodity futures. Why? Well, there were short crops in both Canada and the US, and this is inelastic demand. If you're using oats to make porridge, or if you're using oats to make Cheerios, or if you're feeding your racehorses oats, you don't care that much what the price is. You care, but you pay up and you don't cut back your consumption that much. So we're in a world of increasing demand for oats. Have you had your Starbucks oat latte yet? More oats going for milk. Oat milk, we've seen $9 to $10 a bushel lots of times this winter, mainly in the southeastern prairie, delivered to the mills in southern Manitoba or delivered to southern Saskatchewan for delivery into US mills. Tremendous prices for oats this past year. And I like the long-term outlook on the demand for side. We see solid demand for oats for various cereals and so forth, and new uses, oat milk. And Canada will continue to be the primary North American supplier. And so European oats and Australian oats have entered the US this year because of the short supply and the tremendously high prices, but not in the quantities US mills have really wanted. And they prefer Canadian oats, obviously. But looking ahead to new crop, I don't think we'll see the European Union sending oats in here. Poland is a big producer. Sweden, Ukraine has banned oat exports. New crop outlook for oats is pretty good. But here again, you're looking at $6 to $7 a bushel prices versus 9 to 10 for old crop. So I think it's time to call it a day with old crop and concentrate more on on new crop. And by the way, those new crop prices are good. And if people come through with an acreage anywhere close to what is shown on this graph, we're going to have all kinds of oats in the new crop marketing year. So we're going to have good demand, yes, but we're going to have a big supply too. So this is one crop, I think. I'd like to be 100% sold. And for people who aren't, I'd be shopping around and working on a sale of those oats over the course of the next couple of weeks. For new crop, here's a place where if you're comfortable going up to 35% sold is a good idea. There were some companies offering act of God clauses a few weeks ago. I don't think they're out there anymore. I think a lot of the oat buyers have secured an oat acreage that they're increasingly comfortable with. So the new crop markets are going to be under some pressure. But this is a crop where the market worked hard during the fall and winter at the job of fixing the shortfall. High prices have cured high prices. People are going to grow more in the new crop marketing year. And I think it's a bit dangerous to be growing oats on spec. I mean, if you're putting in a big crop of oats and none are forward contracted, you're basically growing for last year's market. Now we look at peas, and yellow peas have been the star. And so here's another bull market of many, many bull markets across the board. New highs for yellow peas. Green peas did not actually exceed their 2013 peak during this array of bull markets. Green peas have been under yellow peas, as you know. So the Americans wanted our peas and they wanted the yellow ones. And there's an expanding alternative protein industry, and the Yanks were our best buyers. And so some of the best prices during the marketing year so far have been in the southeastern prairie. And as you know, there's that huge new Roquette plant taking in peas at Portage. And a recent sale to China has actually helped the prices in the western prairies. And we've seen over the course of the past couple of weeks, a few bids back up in that $17.50 to $18 area, depending on whether you're talking delivered or picked up at the farm. And so you're looking at some very good prices for yellow peas, which seem to be leveling out in the $17 to $18 area as a general ballpark price. And greens have been trading under the yellows. But the interesting thing is, and this graph doesn't show it, that green peas have been creeping up lately. So you might yet see green peas back to 16 bucks. And looking ahead, at the time of our acreage survey a couple of weeks ago, people were planning on putting a lot less peas in the ground. And this is in general supportive for the price outlook. China will continue to be a big player in the world forum in the new crop marketing year. I think China's going to continue to need protein. Soybean meal is super expensive as a feed, and we're going to see less competition from Eastern Europe. Ukraine can grow 600,000 tons in a good year. That's way under our 4 million tons, but nevertheless, it's enough to matter a little bit. Russia is a bigger player in the market. Will people use Russian peas? Will Russia get them out? The upset in Europe and around the Black Sea could be supportive for new crop pea prices. Another thing about new crop peas is that if you look at a new crop pea contract for human consumption peas of 12 to 14 bucks a bushel, that's way under the old crop market. And we're looking at feed peas quoted at $12 to $14 a bushel for spot markets for, like March, April. Well, peas are going to come off, one of the earliest crops to come off in Western Canada, and they're going to come off during the high old crop barley prices, the high old crop corn prices. Feed markets might be lower when peas come off, but are they going to totally collapse? There's a good chance that even feed peas are worth 12 bucks a bushel at harvest or close to it based on what we see in the world today. So that's kind of a floor under new crop prices. And so that says there's no dire need to be a super aggressive contractor. So we were 85 to 100% sold on old crop. The final increment has been a bet on China. China has arrived. The green light is on to finish yellow pea prices. New crop way below old crop. Several reasons for support, which I just mentioned. Our formal position is 20% sold. If not sold to that degree, no rush. For green peas, we've been just 60% sold. We didn't like their price in relation to yellows. The door is opening now for another sale. Greens could be a good dark horse crop to grow on spec. Here is a market that people have run away from the past year. More people are going to run away from green peas because of their relatively low prices the past year. People haven't been particularly avid on the buy side about getting out there and securing acres. So maybe this is your crop to grow on spec. Maybe this is the dog that'll become a star. Now let's take a spin through red lentils. They're down from their highs, mainly on Australian sales. You can see on the graph there, lots of trades at over $50 earlier in the marketing year in the fall. And recently, most bids were under 40. But a minor uptick recently has improved prices into that 39 to 40 cent area. You might find more. If we're lucky, we might get a bounce into the 42 to 45 cent area. That's not assured. But a rising tide lifts all ships and might lift lentils a little bit. So key question marks looking forward are demand from Southeast Asia, including India. India purports to have a great pulse crop and is expected to probably not want as many red lentils, but you never know. India and a lot of other countries are encountering food security issues, and government policies are going to move among many countries that import things toward having some supplies on hand to cope with emergencies. Turkey is a huge wild card in this. They're sitting right there on the Black Sea. Will Turkey be able to, and will they be willing to, import lentils and process them and then ship them out to other buyers? So there's lots of moving parts in the red lentil market here moving forward. Shipping costs, container shortages, and so forth have kept green lentil prices under wraps. Moderate bounce is finally occurring, 55, 56 cents. It's not shown on the chart here, but this little bounce could take green lentils back halfway or maybe more toward their recent highs. So you've got a good opportunity coming forth here, hopefully in the next week or two, to move some green lentils that are still sitting around. I think, though, that to poke this sector into new highs above its August-September peaks would probably require a weather problem this summer, and that's a little ways off. No surprise that lentil acres are intended to be up. This crop did a lot better in the dryness last year than a lot of crops. And the roughly 4.5 percentage point increase for both reds and greens will help rebuild stocks in 2022-23, weather permitting. Again, though, this crop is, we don't have the inventories that we've had in a lot of years coming into harvest. And although we've got good harvest time prices for lentils, they're not super high compared to everything else. So the lentil outlook, I would say, is neutral. There's potential for moderately higher prices, but I'd call red and green lentils kind of neutral for 2022, 2023. This is not something that's going to be dramatically affected by the Ukraine and Russian situation. We're at 85% sold on old crop reds, catching up as advised now into the small bounce. 60% on greens, catch up now or soon, using the current bounce to 55 cents or better for large greens, and consider an additional increment to get to 80% sold soon. For new crop, we've suggested going to 20 or 25% sold in the 35% zone or 35 cent zone. Anything over 30 cents is actually a pretty good price for new crop red lentils. And for greens, it's reasonable to start now or soon in the 40 cent plus area, if you can find that for large greens, I think. Lentils are not a market where you can see some spike ahead. Of course, you never know with this market. I mean, if India runs into some last minute weather problems, or some of the Southeastern Asian buyers, that could change things. I'm not bearish or anything. It's just, it's hard to find a lot of factors that could make these markets explode. Just a small increase in flax acres. This is a new crop market that's going to be very interesting. We've seen a very strong old crop market, bull move to over $40, then prices eased. And now it looks like the old crop market is making a bit of a comeback here, because Europe will probably turn to us for more old crop and new crop flax. They don't want to buy it from Russia. They probably won't want to buy it from Kazakhstan, which is aligned with Russia. And Canada is coming into a time when the lakes will be opening soon. So some bookings from Thunder Bay could come through. And although prices are extremely high, there could be some buyers that are prepared to pay them for the small dribs and drabs that are still out there. And meanwhile, the new crop market has been well under the old crop market in the mid-20s. And so there's upside room for that, particularly with our acreage survey, if it's accurate, not portending a big increase. No rush to sell new crop flax. Canary seed, steady she goes on acres. This is not a food necessity. Not to say we're bearish, but this is not a crop that you want to hang your hat on for war-related moves either. However, the new normal could and should be above the 40-cent area. You know, we're moving to a higher trading level, it seems, for a lot of crops. We're going to move up and down. There's going to be wide ranges. The extreme highs are going to be followed by extreme lows. But in general, during the next few years, it seems like we're into a higher trading range than we thought we'd be pre-war, pre-inflation days. More chickpeas might be on the way with more acres despite lackluster prices. And look at this graph here, and you can see the big acreages of 2018 and 2019 and 2020. And that spoiled the market for the next couple of years. Chickpeas were very low priced during a lot of 2021 and even recently. As a result of the drought, they didn't come up that much because there was close to a year's supply in the bins. So that's a good reason for chickpeas not setting the world on fire, where a lot of other special crops were doing a lot better. And but we're seeing at least a little bit of a bounce up here for chickpeas, giving people the opportunity who have been hanging on to sell for prices that are a little better than they were, 2, 3, 4 weeks ago. And our survey has a small sample size, so acres might not be up that much. But that's a lesson to be learned too. The excitement in chickpeas and the overproduction created the bear market for chickpeas that followed us right through into mid-2021 before the drought shook things up a little bit. Mustard is the red hot market, the hottest of all. Some yellow mustard has been sold at $1.80 a pound. And now Ukraine and Russia, they're important producers. So who knows where mustard prices could go. Good crop to grow. Lots of people want to grow mustard if they can, and if they can get the seed, it's a decent idea. Even if acres jump 50 to 60%, that's not big by historic measures, and the shelves will be empty coming into new crop. This is a highly weather sensitive crop. We could see another year of generally strong mustard prices. So here are my closing thoughts. We're into a war-driven rally, creating anger, panic, speculation, forced short covering. This is creating opportunities for sellers, particularly on the old crop side if you've got some. And it could create some more as we move through the new crop marketing. Trade flows will not revert quickly to what was normal from 1990 through approximately 2016. The Black Sea world is changing, and this has indeed changed the world of grain trading. Russia seems to be building another iron curtain around itself. Market inversions means there's some upside room for most new crop markets, and they're great. I don't want to create false promises here or false ideas, but I do think you grow what you can, you grow what works on your farm, and the demand will be there. Stay with incremental selling of crops and incremental buying of inputs. And here's an important consideration. Global attention is going to be directed to energy security and food security. I've never heard the term food security mentioned more often in my life than in the last couple of weeks. Food security, food security, food security. Countries that import food are going to be concerned about locking in supplies. Countries that export food are going to consider export limits in order to hold food at home. And the constant lesson of history is the dominant role played by surprise. Just when we are most comfortable with an environment and come to believe we fully understand it, the ground shifts under our feet. By renowned economist and humanitarian Peter Bernstein, and so it is today. There you go, folks.
We'll try and handle a couple of the questions here. There's a couple kind of around cryptocurrencies. So the first one kind of asks, if the US is healthiest in the glue factory, what are your opinions on cryptocurrency? And then another one, just to kind of combine it with you, is also asking, how does the crypto affect the stock markets?
Well, first of all, cryptocurrencies have no intrinsic inherent value, but you could say the same thing about paper money, because really it's an IOU issued by governments. So I think cryptocurrencies are kind of risky if you actually put your money into them, but you can have a portfolio of stocks and other things, and you can buy cryptocurrency ETFs. There's one in Canada in Canadian dollars. So if Bitcoin goes up, that ETF is going to go up. And I recently looked at how low it was and actually bought a little bit for my portfolio to hold it there, because I'm wondering if some people around the world are going to move into crypto. So I've been asking myself the same question. As for affecting the stock market, I don't think cryptocurrencies have a great deal of impact on the stock market. Next question.
Here's one on selling canola. Do you think the optimum time to sell new crop November canola, which is priced at $21 for crusher delivery, is at or near the high of the new crop?
I think it's getting pretty high for the new crop market for the time being. And if you haven't sold any yet, you might want to pull the trigger on 5 or 10%. But I want to make clear, in the wildness that these markets are in this upset world that we're in, nobody's going to be able to call a top on this thing. And I've shown you some charts that I don't see a top on the chart, but I might see one tomorrow or the next day. And whether canola is $21 for new crop or 22 or 23 or 19 at that time, I'm going to tell you when I see the signal on the chart, and that might help you with your decision making. One other thing that comes up here is some people start talking about seasonal tendencies. A guy said recently the durum market for the last few years has topped in June or July. The canola market usually tops in the last several years, April or May. You can throw seasonal tendencies right out the window when markets get wild right now. The seasonal tendencies work during calm market times, and they don't matter now. These markets could peak any time of year. This is different. The world is different.
Okay. I'll just handle. My apologies to everyone who did send questions in. We won't get to them all just due to time.
We got time for a couple more.
Yep. Thoughts on a potential CP strike and which markets it might impact mostly?
Well, I think it'll affect wheat as much as anything. Although, it's not gonna help any market. But I have got to believe that, or hope that, notwithstanding the stripes of the government we've got in there, that this will be considered an essential service, and that this can be resolved so that it'll be disallowed. That's what, let's hope, eh?
Okay, there's a couple questions here on lentils. I think you kind of covered it, but I'll just touch quickly on it. So do you think they'll head to 50 cents again this crop year?
Red lentils?
Yes.
Well, you might want to take 10% of your crop and put a target there. But I think that's unreal, a little unrealistic to bet the whole crop on. You know, as an incremental kind of a guy, I'd be pretty happy selling a little bit at a little over 40 here, some at 45, and then hold out for some at 50. But like I said, I just don't think this is going to be an explosive old crop market. If you see a lentil move, you know, you might have more upside potential for new crop. But that's just my feeling. I don't see this conflict affecting old crop lentils directly immediately.
Okay, I'll just handle two more questions and then we'll wrap it up, John. Should new crop brown mustard be contracted at 70 to 80 cents?
Not a bad price, is it? It's low compared to where these markets went last year. There again, you know, sorry to be a broken record on this, but I'd probably contract some, take that to the bank. You know, you can make money on it and then speculate with the rest. But shop around, no rush. This is a big crop in Russia and Ukraine, and it'll be interesting to see what happens. You know, if the Europeans can't get mustard from Ukraine, and they won't buy it because of sanctions for Russia, where are they going to have to go for it? And, you know, brown mustard is used for a lot of different applications. And for certain food manufacturing, you know, demand could be cut back. But mustard in a jar, people don't care. It's a small item on the table.
Thanks, John. Just one more question and then we'll wrap it up due to time. There's some talk of India's wheat supply. Do you have any comments to share?
Wheat's got lots of supply to sell and is selling it into the world market right now. The country that's got a wheat crop problem that just cropped up in the last few days and became public knowledge is China. So if the wheat market is going to get another kick higher, it could get it from based on what's happening in China. But it's India's sales of wheat, I think, that are capping the wheat market at this point. Globally, the world wheat supply is ample to meet the needs. It's a matter of where it is sitting. India is an exporter. China's a net importer. Will India allow Russian wheat to come into the country? Maybe, maybe not. China will. China will buy Russian wheat with both hands if the price is right.
Okay, well, sorry to everyone that we missed out on some questions, but just due to time, I think we should wrap it up for everyone. But thanks again, John. We greatly appreciate your insights and the feedback we get from you. And
just one comment, Trevor. If people have questions for me, you can send them directly to me. You've got the email address. You can send them to Trevor, send them to a Syngenta rep, and they'll forward them, and we'll look after them that way. I had a lot of slides to show you, and I maybe went overboard on that, but I really wanted to show you, to give you a complete picture of what we're looking at in here. So thanks very much.
Oh, John, that's excellent. We do appreciate it, and it's okay that you're over time. That's not an issue. But for everyone out there, if you're not, John makes a good point. You can contact him direct if you're currently on it. But if you're not on Good Morning Prairies or his marketing update, contact your rep and we'll get you signed up. and we'll get you the information from John, which either comes out daily or weekly, depending on which. So we always do appreciate it. But thank you very much, John, and I hope everybody enjoys the rest of their day out there.